You're listening to Ask the Expert on Sprott Money News.
Well, welcome back once again to the Sprott Money News, SprottMoney.com Ask the Expert show. I'm your host, Craig Hemke. It is October 2022, and joining us this month is a new guest, Michael Oliver. Some of you will be familiar with Michael through his great work. Momentum structural analysis is how he terms it. You can find his work at Oliver MSA for momentum structural analysis.com. He's been an analyst now for over 40 years and a well-respected voice in the industry. So Michael, thank you so much for joining me.
Thanks, Craig. Good to be here.
It's really a pleasure to make your acquaintance, Michael. I know on my site, lots of folks follow your work, and I'm sure other people listening to us are big fans too. If you wouldn't mind, just take a second and tell everybody a little bit about your work at olivermsa.com.
Well, I got started in the future side of the business in '75 with E.F. Hutton. Remember that firm?
Yep.
Their headquarters, commodity headquarters in New York, down in Battery Park. And I trained under the head of the department, who was also chairman of the COMEX. And this is back when gold had just been legalized for trading on the COMEX, 1975. Yep. I was a novice. I was a kid. Okay. And I learned a lot. He was an orthodox technical analyst, price chart stuff. And he taught me that and so forth. But over the years, I evolved a momentum-based methodology wherein I would plot price action, but I'd plot it as an oscillator in its relationship to certain moving averages. Now, I don't mean laying the average on a price chart. Anybody can do that, but oscillating the price. So, for instance, if today's price is $10 above the 3-day average, then on a 3-day average oscillator, today's high would be plus 10. You follow what I'm saying? So when you create an oscillator, a momentum chart, and we often use very long-term means like 3-year averages, 36-month, 3-quarter averages. So we're looking at mainly the major trends. We see different picture than what you see when you look at a price chart. And usually, and when I say usually, I mean it without being cocky about it, 80 to 90% of the time, if a trend is going to change, it will change first and clearly on momentum, not on price. Price will be a lagged indicator. And so we based our research reports on that. We cover all 4 major asset categories pretty much globally, equities, bonds, commodities, especially gold and silver, and the debt markets. And in today's age, those things are interrelated.
Yeah.
What the debt markets are doing affects a lot of things, and the foreign exchange markets, et cetera. So anyway, that's what we do. Primarily, our customers have been institutional. 5-6 years ago, we opened it up to individual subscribers. But we provide about 5 reports a week, so it's pretty intense. A lot of reading. But anyway, that's what we do.
All at olivermsa.com. And you mentioned working at E.F. Hutton. As we record this, it's October 19th. It's the 35th anniversary of Black Monday. Where were you that day? Just out of curiosity.
Well, I wasn't there.
Okay.
I had been there prior to that, going back and forth to New York, starting my business, actually. That's when the Al-Qaeda blew up the World Trade Center. It was a parking lot at one of the World Trade Centers, if you recall that. And where they had a bomb go off in a garage parking.
Right.
Yeah, I think it killed a few people, but they came back and finished the job. They apparently figured, well, that didn't work. Let's try something else. And sure enough, years later, they came back. But no, I was not there at the time of that event. I was down in North Carolina, I believe.
Hard to believe it's 35 years.
Yeah, it's that long. Yeah.
My goodness gracious. All right. Well, and one more thing before we get started, please, everybody listening, remember that this is all brought to you by SprottMoney.com. There's a couple things you can do to thank them for bringing you this great content month after month. You can go to SprottMoney.com. Always check them out for their deals on physical metal and on storage of that metal. Great deals all the time. You can actually call them as well at 888-861-0775. But hey, if anything, just shoot them a like or a subscribe on whatever channel you're listening to, and that'll help them spread the word on precious metals as well. Michael, let's get started. I've got 7 questions for you. The first one, I guess, actually kind of plays right off of what you were just discussing. This person doesn't really understand traditional technical analysis, but would like to learn more. Where would you send someone to get a kind of a basic education in technical analysis?
Oh, gee. Actually, the best book is a guy I knew back at Hutton, and his name is Arthur Scleroux. I don't know if he's still around or not. Scleroux, Sklerew. You can go to Amazon.com and find Arthur Scleroux's book called, I recall the title, it's Techniques of a Professional Commodity Chart Analyst. It's probably the best book I've ever read on orthodox technical analysis. He does venture into some momentum type things, but it's a great book for beginners, and I think it's got solid ideas, unlike a lot of technical books that tend to go off into almost religious type tones about the magic of this timing or something. Anyway, that's a good book. I recommend to anybody who's just starting out.
It's Sklerew.
Yeah, Arthur Scleroux, Techniques of a Professional Commodity Chart Analyst.
All right, I like it. I'm going to check that one out myself.
Yeah.
All right, let's move on to question number 2. This gets to the heart of the matter in current markets, I guess, and that I think, at least my perception, I suppose a lot of people listening, is that the Fed will attempt to keep the plate spinning rather than crash all markets. That pivot is eventually coming. In your mind, what will be the primary cause of that pivot? Will it be a crash in the stock market? Will it be something, runaway selling in the bond market? Maybe something in the emerging markets? So where do you think it might come from?
All of the above, but no, primarily, I think there's something that nobody's talking about. They're looking at the stock market coming down and they're thinking like a normal bear market and, it's et cetera, et cetera. This is not normal, folks. The stock market is the biggest equity bubble in U.S. history. The S&P went up 7-fold due to QE's infinitum from 2009 through 2021. And the NASDAQ 100 went up 16-fold. Find me a bull market that had any kind of metric like that. The 1929 top was like a triple, okay? The dot-com bubble was hardly anything more than about a triple. The move from 2003 low to 2002 low to the 2007 real estate high was a double. Okay, so when they collapsed, they were very painful. The real world felt it. But we have a bubble like you've never seen. The central bank created it, and now the central bank has pushed a pin into it. It has burst its own bubble. It will be out of their control. They can try to stop it at some point. Right now, they're helping to exacerbate it. And I think you've got to watch the bond markets right now. U.S. government, UK, Japanese, I'm talking government bonds now, the precious asset, right? The one the Feds, the central banks must defend come hell or high water. They have to defend those things, regardless of what their policy intents claim to be. They're going to have to print to defend those markets at some point. They also have to protect against what's going on in the Forex markets, because the recent dollar strength, and I say recent, since May especially, has exacerbated the T-bond crisis in Japan and the UK especially. And we're even at a point now where Yellen, a week ago, said she was very concerned, and I put quotes around it and an exclamation point, about illiquidity in the US T-bond market. Illiquidity is a disastrous term. Down is one thing, illiquid is another. And when she used that term, she's recognizing reality out there. And she's very concerned about it. And it's going to require at some point, now the longer they delay, the worse it'll be, that the central banks will have to come in and defend these assets, meaning they're going to have to print. So they can talk all they want about a given direction, but when that asset gets into jeopardy, the game changes. And I think gold knows that.
Right. Well, you know what? I'm going to shuffle the deck here on the order of the questions in, because you kind of teed me up for question number 3, Michael. If the Fed does cause a liquidity crisis, and it certainly seems to be trending that way, do you have a downside target in mind for the S&P?
No, except to say that it should be very painful in the real world, because when you have a dozen years of artificial pricing of paper assets, not just the stock market, but muni bonds, which have collapsed huge, high yield corporate debt, which has collapsed now such that high yield corporate debt using HYG as an ETF, for example, the only thing left for it to take out are the 2009 lows. Do you remember those days? Okay.
Yeah.
So we have a crisis. And once it comes unwound, it reveals errors that were made by individuals, corporations, and governments all during those years based upon false economic assumptions. Assumptions based on where will rates be? How much is the cost of money? How much is the quantity of money? If all of a sudden the Fed tries to change that, it's like 52 card pickup. All of your assumptions go out the window and decisions you made exposed, the errors are exposed. And even if they try to come in and rescue it, it's highly likely, and this is true in the past, by the way, that fund, that river flow, a renewed river flow from the central banks will not go where they want it to go. It's highly likely to more so go into gold and into commodities to a lesser extent than gold. It will find a different asset category to go into this time around.
I might follow up with that because on my side, I've talked about how, they've pulled this trick now 3 or 4 times since 2009. QE was a one-off and we're going to raise rates back to normal, whatever that is, or run the balance sheet back down. And this is like the 4th time that the markets have seemed to believe them. Do you think maybe this next time everybody will roll their eyes finally and go, yeah, it is not going back to normal?
No, there's a point of disbelief. And, I think there's still a belief in the Fed and its sobriety and so forth. But I think that's going to go out the window in the next, wouldn't surprise me if it goes out the window next year, meaning faith in the Fed, having any confidence in the Fed.
Right.
In fact, right now, you can hear a cacophony of voices out there from mainstream pro-Fed type economists who are saying, oops, maybe you've gone too far.
Mm-hmm.
Uh-oh. And they're recognizing the underlying reality. And the longer the Fed doesn't recognize that, the worse that reality will become.
Yep. I agree with you there. All right. Let's go on to question 4. This gets back really, I guess, to a lot to what you do with momentum structural analysis. What cues do you look for in detecting market tops and bottoms?
The same type of things that people would look for in a price chart, for example, basing action. But the interesting thing is you'll see momentum create basing action, meaning it goes down to a certain point, and then suddenly the momentum action starts to go sideways, okay, build a base. But you look at the price chart and it's still going down. So the price is not telling you that there's a basing action underway, but momentum will tell you that. For example, well, you even start to see it to some extent in price right now among the gold miners. In July, for instance, the GDX ETF was trading just above 24 near a low. Well, heck, we've been trading either side of 24 this month. It's August, Sep, Oct. Okay, it's 3 full months later, and we're flip-flopping around sort of sideways with the downside bias. But most of the momentum readings are not going down to new lows. They're making higher lows. So we're getting a deviation there between gold miners and so forth versus what you see on the price charts. And that's like an early warning that, hey, yeah, price looks terrible, right? Don't count on it. Price never looks good at a low, ever. You'll in fact find any major low in gold or in the gold miners historically and look at the price chart when it occurred and it looks terrible. Right. Usually momentum, though, will not look so terrible at that same point in time.
Silver kind of looks that way too, doesn't it?
Silver, absolutely. In fact, it's our assessment that the silver-gold relationship, the spread difference between them, and we measure that continually, has now shifted positive to silver. Now, it's not bloody evident on the price charts, that's for sure yet. But when we plot silver as a percent of the price of gold, and recently it got down to like near 1%, the price of gold. And it flipped back up to about 1.3%. It's broken out on momentum. Not so much evident on the spread chart itself, but the momentum says the downtrend that we've seen in that relationship, which has been ongoing since early 2021, by the way, where silver has been losing value to gold. So for more than a year and a half, silver has been underperformer. Momentum says, nope, don't count on that continuing. Looks like it's turned. So that's one of the signs we look for, because frankly, the spread change in silver and gold is usually very telling about the net trend action of those markets, meaning when silver shifts to an outperform status, however subtly it does so, that usually is a warning indication you're about to have a net trend positive for both markets, with silver leading. And I think that's where we are now. We're on the cusp of that.
Well, now, Michael, I've got to shuffle my questions again, because what was going to be the last question, I've now got to move up to question 5, because you've teed it up so perfectly. Question 5 becomes, what is your outlook for silver? Will it ever see $50 again? And do you pay much attention to the gold silver ratio?
I do. We do pay attention, but we pay attention to its momentum. By momentum, for example, we have a breakout last month where momentum measured by the 3-month average of silver versus gold, plotting an oscillator again, broke out above a base that's a 1.5 years wide. Okay, now, historically, if you go back to the mid-70s, gold was coming up from the $30 range to $200, 1975. Dropped back to 100, went up to 850, dropped back to 250, went to 1900, et cetera, et cetera. That ratio of silver to gold has swung. There are many, many years in that last 40 some odd years where silver ratio, as we measure it, has risen above 2%, meaning the price of silver was more than 2% the price of gold. Well, even at current levels, let's say gold's at $2,000, okay? 2% of that is what? Okay, it's off the page. It's way above where we are now. Silver's been at 6.5% the price of gold. Several times it's been up above 4% the price of gold over the last 40 some odd years. So there are many moves where silver has been up to 4 to 6% over the price of the price of gold. Well, now let's go back to gold. Gold has produced since the early 70s 3 major bull markets, each of which was either a 7-fold move or 2 8-fold moves, measuring from bear market low to bull market high. So in other words, 3 times in 40-something years, it's created 7 to 8-fold bull markets. We certainly have a fundamental environment that would justify another major bull market. In fact, we're probably in the middle of one. Well, our last bear low was at 1,050. If it merely went 8-fold again, replicating prior bull market trends of the last 40 years, it'd be $8,000 gold. Well, if silver were merely at 2% of the price of gold when that occurred, okay, silver, what, $200 plus dollars. Okay, so its potentials on the assumption that there's more gold bull market here, which we think there is. We think we're only in a big pause period. And silver goes to its normal ratios. Like I said, in many of the years of the last 40, it's been over 2%, the majority of them, in fact. Then if gold went to a normal 8-fold move at some point, a year or two from now, due to the financial crisis that's now developing, silver could easily be a couple $100 an ounce. So could it go to 50? Yes. It would not be abnormal whatsoever, and I don't think it would stop there.
The current, in your, I guess, historically, watching these prices, the current 1% or so, or expressed differently, a ratio of 100 to 1, that's pretty unusual.
That's pretty low. Yes, it is. There have been times before we've been this low, so it's not that unusual, but it is an extreme. And so if you like buying low, think about buying silver versus gold now.
Yeah.
Okay. Unless your assumption is gold's going to $200 or something, and it's all over. If you assume that, you don't understand what central banks are all about.
Right.
They create paper money, and they do it primarily to defend government debt. Right. And that's where the crisis is we're now facing.
And getting worse. Okay, Mike, just 2 questions left to go. The 6th question goes back to gold and the gold miners. You'd mentioned some of your momentum analysis looks like perhaps GDX is basing. Question 6 was just simply that. Do you expect gold and the gold miners to turn higher soon?
Yes, and we've said some nasty words about gold miners a few years ago. It's a broad general observation that the miners are like, and silver to some extent too, this is true, are like little yapping dogs on a leash. Gold is the mama. Gold holds the leash and ultimately determines the major trends. But even when gold has a modest pullback on a percentage basis, the gold miners go berserk on the downside.
Yeah.
Get an XAU chart, for example, at Philadelphia Gold Silver Mining Index. It goes further back than GDX. And overlay it. Go back to 1999, for example. Gold was making another bear low then at about 250 and went to 1900 within the next decade. Look what XAU has done over all those years since then. It's gone back down under 100 repeatedly, gone well up. But while gold makes continually ascending, sharply ascending lows, in other words, an upward curvature trend over the last 20 plus years, the gold miners keep coming back down to the mat again. Now, my assumption there is that though it's a small sector, we know that in terms of, compared to any other stock market sector, and the investors in that arena are obviously very emotional. They get very emotional on the upside, which is, of course, great if you're long, and they get very emotional on the downside, and they don't seem to understand that process. And I think we're at one of those points now where they've gotten super emotional on the downside without solid justification. And therefore, we're looking at basement bargain opportunities in the mining sector if you take an investment grade view of it. Now, if you're looking to trade it in the options for the next 2 months, then that's a different story. But I think we're now in one of those zones again where the gold miners should be viewed as the multiples on the upside are incredible at this point compared to further downside risk.
All right, one last question then. We've spent a lot of time talking about inflation. You just mentioned a few minutes ago about how that's the central bank's job is to print cash to fund government deficits in the current system. I mean, I don't know, maybe the Fed will get it to come down some, but structurally it seems like it's here to stay, at least to me. So as inflation in the US worsens, or at least stays the same in the years to come, do you think the S&P, equities in general, will outperform gold, or will it be vice versa?
I think they're about to vastly underperform. They've done fairly well over the last 50 years, obviously, the stock market has, U.S. market in particular, largely because of central bank boom-bust cycles. And this particular last one is a major boom cycle, which is now in bust phase. But no, I think because of the nature of the bubble that was created and therefore the unraveling of that bubble, which is going to occur, whether Fed wants to reverse course at some future point or not, it's going to occur, will make stock market vastly bad place to be. And in fact, it wouldn't surprise me that in the next bear market in stocks, you get a situation where, unlike prior boom bust cycles that are refed with liquidity and they go back up, make a new high within several years, you could be looking at a decade or two where it's just lays in the weeds. Much like, for instance, after the 1974 bear market low, stock market was a wasteland. It rallied off that low, but then it went sideways to 1982 before it could get its engine going again. So I think that's the kind of outlook we've got for stocks. One, major down. Two, don't count on a quick turn to the upside that sustains. Instead, expect a wasteland. And as far as inflation goes, I think people misdefine it. We have constant inflation. The stock market bubble was inflation, meaning money chasing an asset, money created out of nothing. Just so happened that asset managers and investors allocated that river flow into the stock market. They've now begun to, as of late 2020, when we called a commodity explosion at that time, and it's since exploded, well before the Russian invasion, by the way, we thought that the asset flow, the river flow, would go into commodities because they were vastly underpriced to stocks. And sure enough, that's what's been happening. And I don't think that's going to end. I think right now in the commodity area where you're getting a pullback right now, Bloomberg's down around 110. It's been up to in the 130s, for example. We think you're probably near a corrective low with more to go on the upside. But once investors and asset managers make that kind of long-term mental shift out of one category they deem to be now high risk, lower reward into something they consider low risk, higher reward, they don't shift back within months. They usually keep that trend going for several years. And that's what I'd expect here. But commodity, quote, inflation is not the definition of inflation. It's the monetary expansion. Get an M2 chart and go back 50 years. From the St. Louis Fed, you can get one. Yep. Look at an M2 chart. It's gone up 20-fold since the mid-70s. What other market's also gone up 20-fold since the mid-70s? Gold. Inflation's been there the whole time.
Yeah. Michael, this has been fantastic. Very, very informative. And I think for everybody listening, they can obviously benefit from learning more about you and your services. Again, they can go to olivermsa.com. Is that right?
That's right.
And your services is subscription and information you put out on almost a daily basis.
Almost a daily basis. And we describe on that site our methodology. Also, you can find my lovely picture there. Right below it is an email. You can send me an email and we'll send you sample reports, recent reports. There are also some samples on the site, but they tend to be dated.
Yep.
But you get a good idea of what our methodology is and some of our past history.
Great stuff. Michael, thank you so much. I want to remind everybody on your way out, again, please thank Sprott Money for this content. It's as easy as a like or a subscribe on the channel you're listening to, or of course, you can always pick up the phone anytime you're in the market for physical precious metal. That number again, 888-861-0775. Our guest has been Michael Oliver, Momentum Structural Analysis. Michael, thank you so much for your time. It's been fascinating.
Thank you, Craig.
And from all of us here at Sprott Money News and SprottMoney.com, thank you for listening. We'll talk to you again next month.